So we're starting with the preliminary questions, just some practice questions. We'll go over and we'll talk about them. So just take about 3 to 5 minutes and go through and give your best guess. Just so you know, in the schedule. Differs. So very. I'm going to be able to cover at any one time. Okay. Let's go ahead and walk through these. At the date of the financial statements, common stock shares issued would exceed common stock shares outstanding as a result of. So Dave, at some point, right, we remember we have kind of 3 shares. So we have board authorized. And then we have outstanding. And issued. So the board can authorize however many shares. Management can choose how many to be issued. The difference between what's issued and outstanding is generally treasury stock. So that first one is C. Number 2, which of the following statements about property dividends is not true? So a property dividend is usually in the form of securities of other companies. That is generally true, usually, but property dividends can be merchandise or real estate as well. So A and D are true. So we're looking at B and C. A proper property dividend is also called a dividend in kind. And the accounting for a property dividend should be used based on the carrying value, book value of the non-monetary assets transferred. And so in this case, it's not the book value that we're worried about when we transfer assets, it's the fair value that we worry about. So C is our second answer as well. If management wishes to capitalize part of earnings, it may issue. And so this question, what do we think about when we capitalize something? Right, we're usually thinking about long-term, right? And do and spend, but they're going to capitalize this. Well, in this case, what management is doing is saying, we're not going to return in dividends or in stock buybacks this money, but we're going to use it within the organization. So the only thing they can really do here is do a stock dividend, and that would be letter B. Cash dividend would not capitalize. Property dividend would not capitalize, right? They're giving you an asset. Here with stock dividend, they're just giving you more stock on the stock you already own. Now, is that effectively giving you anything? It is not. So what is the philosophy behind it? The philosophy is that it makes your stock more affordable on the market. And in theory, that will kind of increase the group of people that can buy that stock. And as a result, they hope that the price will go up. And theoretically, that shouldn't make any difference, right? If a company has value, it shouldn't work that way, but that's the kind of theory behind it. The effect of the issuance of a 2-for-1 stock split have on each of the following. So what happens is you have twice as many stocks that are still worth the same amount. If your stock was $100 and now you have two, because they split, the value of your stock splits in half. And that also cuts the par value. So your par value decreases and there is no effect on retained earnings. So that is C. And then the last part, assume common stock is the only class of stock outstanding in Menlo Corporation. Total stockholders' equity divided by the number of common stock shares outstanding is called. And so if you think about it, what do we have? That's our book, right? Our financial statements, our ledger. Total stockholders' equity. Value per share. And so the answer is A. So for answer C. C. Okay. So you should have a blank page, and if I remember correctly, and this is the one I was telling some of your students earlier, as you get older, you can never remember where you left off or left anything. And so I think I left off because I moved the treasury shares from that last one to this discussion. So I think here we are going to talk about treasury shares and the entries. A couple things to note. Treasury stock is not an asset. It's a contra stockholders equity account. The company purchases treasury stock. Assets decrease and equity decreases. One of the things I'm working on with the first level accounting class is to keep in mind, you know, when you do assets equal your liabilities plus your equity, you can have transactions that kind of exist on both sides without crossing over to the other. So if you were to purchase a building for cash, right? Let's say 200K, you can have a building of 200K, right? And the effect of this transaction is zero. And so you don't have anything going on file, right? And so my students, the freshman. But this can happen, and essentially what you're doing here is you're just reducing cash. And then you're going it out to the equity and you're reducing retained earnings. And what you're doing is, I'm sorry, it's unrepaid capital. And you're reducing that. So,
Confused me at first when I was like, why is it not an asset? Appreciates what the value of the stock.
right, and really, it's not a. Companies use them like they're assets. But because it's dealing with equity, remember, all that stuff kind of gets put in a separate box for dealing with ownership and debt and things like that.
The book kind of didn't explain, it's basically like if they hadn't issued it,
Right.
they're not gonna count that as an asset.
Right. Oh, that makes sense. Okay. So there are kind of two methods. First is the cost method. Record treasury stock at the cost. There is another way to do it, and it would be the par or stated value method. All transactions in treasury shares are recorded at the par value. And in this case, treasury stock is reported as a deduction. Capital stock. So we're not going to focus on that second one. You may have a question that sentence will probably be able to answer it for you on the test or on your homework, but we are not going to be using that method. Most companies just use the cost method. And so we're going to focus on the cost method. And so when treasury is purchased, you're going to debit treasury stock and you're going to credit. And so now the sale of treasury stock has a couple different treatments. And one is if it's sold above cost, and we would debit cash, we would credit treasury stock, and then we would credit paid in capital or treasury stock. And again, I don't know what the exact title is. I can't keep all that stuff in my head, but you get the idea. It could be in excess of treasury stock. And so this would be for your treasury stock. This would be the number of shares times the cost. And then this one would be a plug cash minus treasury stock. Now, if it is sold below cost and if no previous paid in capital or treasury stock, then what you would do is you would debit cash, debit retained earnings. You would credit treasury stock. And the retained earnings part would be a plug, treasury stock, to cash. This is the same calculation. Number of shares times the cost. Now, the next time is sold below cost and some previous paid in capital treasury stock. So you would debit cash. You would debit paid in capital treasury stock for the balance in the account. You would debit retained earnings. And this would be a plug. Treasury stock cost minus cash minus paid in capital treasury stock. And your last one would be credit to treasury stock. And then in the last one, sold low cost, but enough paid in capital treasury stock to cover the difference. So you debit cash, debit paid in capital treasury stock. And this would be for, this is a plug, treasury stock. It's cash. And then your credit would be to treasury stock.
And that's for use page, okay.
Okay, yeah. Just as a reminder. I have to switch now because we're gonna work. Any questions on the entries for treasury stock? Let's go ahead and look at an example then. Okay, so it says in 2025, Cetus Corporation entered into the following transactions. So on March 1st, they issued 200,000 shares of $1 par value common stock for $1 million. So cash, million. Common stock. We had 200,000 shares times $1 par or stated value equals 200,000. And then we have paid in capital common stock. Be the plug for the difference, 800,000. September 10th, bought back 2,000 shares at a price of $6 per share. So we have 9, 10. And we are buying treasury stock. We have 2,006. So that would be 12,000. And a credit to cash or 12,000. October 15th, sold 1,000 of the treasury shares for $8 per unit, so 10.5 in cash. And we have 1,000 times 8. So we're getting cash of 8,000. We have treasury stock. And we know our cost, 1,000. Six. And so that would be 6,000. And then we'd have paid in capital treasury stock. And this difference would be a plug for 2,000. November 20th, we retired the remaining shares in treasury. So this is a little different now because we have to account for when they retire, we have to eliminate the treasury stock, any paid in capital related to it. And we're going to have to eliminate the common stock as well, because that's what it is originally. So what we're doing is we have 1,000 shares, right? So we're going to be eliminating those shares, common stock, 1,000 by their par value 1. And so that is a debit of 1,000. We have, make all the entries here. Paid in capital or common stock. So we're removing that based on what we had for a value. So this is a little confusing because how much are we getting in excess of par, et cetera? Right? And so here we have 1,000 times 5 minus 1, excuse me, 5 minus 1. And so that's 4,000. And then we're going to eliminate the paid in capital from treasury stock. And we know we're going to take the total because we're eliminating all of these shares. So this comes from our previous entry of 2,000. And since we're retiring treasury stock, we're going to credit it. There were 1,000 shares times 6. And so that is 6,000. And we have to balance this entry. So we've got 7,000 here. So we 1,000 into retained earnings. Is the plug for 1,000. Any questions there? Go ahead.
Get the,
So that's the question I would have asked, right? So I think it's when they do it originally. So we have $1 par value common stock for $1 million. And so we end up with, what do we get? $5 per share. We're taking out the par value in that, and we would have had $4 for each one that we put in originally. Right, this 800,000, if we divide this by 200,000, that's $4 a share. So our total common stock when we issued it was $5. This is $5 per share, right? Share. So $1 par value and $4 of paid in capital. Great question. It's getting a little sweaty until I figured it out. Hit that 5, don't ask me too early. Giving everybody time to catch up here. Take your time. If you have any questions, ask them.
If we didn't have any paid in capital,
The full amount would go just to common stock. So this 5,000.
well, the treasury stock, we didn't have any paid in capital there.
Yeah,
That would just to debited retained earnings for 1,000.
yes. All right, so moving on to cash dividends. And so our journal entry. We have kind of several phases, right? Board declares a dividend. Common stock. Preferred. Then it becomes a liability. Now, keep in mind, even with preferred stock, even when it's cumulative, they're only gonna owe it if they pay dividend. So if the board doesn't declare a dividend, they can hold on to that. Now, will you owe it in the future? Sure as heck will. but that's only when you can declare dividends, okay? And so that first thing is you're gonna debit retained earnings. Sometimes you'll see a dividend account, and keep in mind, just a dividend is a contra retained earnings account. I don't like to use it, but they will use it, and alternatively, it's fine. Essentially, you have the same effect. It just allows you to track how much you've declared for in dividends. Keep in mind here, we haven't paid at this point, right? We just owe that money, so we have a credit to dividends payable. You have? It really shouldn't be an expense, but as long as they record it properly, then you're okay. If they put it in retained earnings, if they put it in with an expense, then you have an accounting issue there. So your second important date is the record date. The record date locks in ownership of the shares. Thus, whoever owns the shares at this time will get the dividend. There is no entry. So the record keeper the record keeper for whoever does the shares has to record something and say these are who owns it.
Most of the time they use it for service. So you do anything, you just say, okay. We're gonna pay a dividend on June 30th. To whoever owns the shares. So April 15th.
So you can own that share till April 15th. And then on April 16th, sell it, and that dividend will still come to you on June 30th. Okay. What have we seen in the past that kind of operates a little funky like that? And you're buying and issuing bonds, buying, and selling bonds, sometimes you got to pay 6 months interest. You'll get, you'll pay whatever percentage you are. So if they're 3 months into the period, you pay the interest to them, and then they send you 6 months back again, right? So it kind of functions a little bit like that. It's not exactly the same, but records and dates are important for preferred stock. Ethan,
So the first.
that is correct. All right, and then to record payment of dividend, we debit dividends payable and we credit cash. Right?
Of the execution here.
I don't know off the top of my head. I just call it payment date, but it could be in there as something else. So just a little note, remember. That's just a reminder, remember that preferred stock is paid dividends first before common stock. If there's no questions, I'll jump into example 2. Take about 30 seconds to read it. This one's going to be fun. All right, so let's walk you through this. So it has 15,000 shares of cumulative preferred stocks. So this means that if they aren't paid dividends, they're owed dividends the next time dividends are declared. So in 2019, preferred shareholders owed 15,000 times 1.04 times $100 par value, which equals $60,000. In 2020, company paid $110,000 in dividends. Okay. So 60,000 goes to the preferred stockholders for 2019. The remaining balance, we have 110,000 minus 60,000. That was going to preferred for 2019 equals 50,000 for 2020 dividends. So preferred receives all 50,000 and has 10,000 in arrears going into 2021. So then we pay 110,000 in 2021. We pay preferred gets the 10,000 owed and 60,000 for 2021. The remaining $60,000 equals 40,000. And so that answer is A. Any questions there? Property dividends, which we've also heard as dividends are in kind, and that's usually stock in one form or another. And so this entry is similar. To the cash dividends. First, the property. It's the mark to market. Or fair market value. Which is the same thing, it's just we use different words for different terms to mess people up. Job security. I can't tell any, like, I'm a mini doctor, I'm a medical doctor, but I can't tell anything they write, and I have no idea how people. As a result of that. Gave him 4 pounds of fentanyl. When stocks of other companies are sold, gain or loss should be recorded. At that point. So we're gonna mark the asset to fair value. So we're gonna debit investment in company X shares. Credit unrealized gain on company X shares. So this assumes a gain. If it were assuming a loss, you have a credit to unrealized loss on company X shares. It's a debit dirt. And a credit to investment company X shares. And just a little note here. Only make this calculation for the shares that will be used as a dividend. So for example, if the company has, say, Apple decided to invest in Facebook, has millions of shares, they may still keep some of the share. Don't change the value of shares at that. And then now the entry to record the property dividend payable. When the board declares. You'll have a debit to retained earnings. And a credit to property dividend payable. Upon payment date. Debit. Property. Dividend payable. Credit. Investment. In company. X shares. You are finished entering that, you can take a read through. We'll go do that. Start going through it. I'm gonna walk you through it. Pearson declared a property dividend of 1 share of Hunter for every 10 cents, every 10 shares of Pearson held by a stockholder. On that date, when the market price of Hunter was $28 per share, there were 135,000 shares of Pearson outstanding. So what gain and net reduction in retained earnings would result from this property dividend? So we have the shares of Pearson outstanding. 135,000. And so we're going to divide the number of shares by 10. Because each shareholder gets 1 share of Hunter or 10 shares of Pearson. So we're going to have 13,500 shares of Hunter being distributed. If we want to find out the cost of the shares, Hunter, we take the 135,000 cost and we divide that by the 15,000 shares. And I get $9 per share. Total cost of the shares, 13,500 times 9 equals 121,500. We want to mark the shares to fair market value. Okay, they call it. And so we have 13,500 shares. And what's the value that we're going to use? $8 per share. $28 per share, because on that date, the market price of Hunter was $28 per share. We have 13,000 times 28. And so that market value is equal to 378,000. And now we figure out gain or loss. And we take the fair market value. 378,000, we subtract the cost. 121,500. And we have a gain of 256,500. So our entry to market is going to be a debit to investment in Hunter Company for 256,000 and an unrealized credit to unrealized gains. And that would be 256,000. Yes. Excuse me 1 second. My son's having wisdom teeth out. I gotta make sure he's not croaked. He has anxiety, and I love him because we all have anxiety at different levels of managing it. And so he decided. Stay. Feel stress. The gas is not gonna do anything, so I'm a little nervous. He's gonna have like a panic attack in the middle of it. Fingers crossed. He hasn't as of yet, hopefully. At least they haven't told me. Okay, and then now we have the entry at payout. So we have a debit to retained earnings. And this is for 378,000. Credit to seem right, that's gonna make that bigger. In 1 second, I had a little mistake on here. This is actually backwards, right? I gotta get rid of the property dividends payable. Oh, okay, so this is not the entry to payout. I just missed one. Record the dividend when board declares. So this would be a debit to retained earnings. And a credit to property dividends payable. Or 378,000, and then when paid it. The dividends payable. And credit. Investment in company X. This is Hunter. What's that?
Not investing in Twitter.
Yeah, no. That would be a bad idea, although that would be the kind of thing I do. I buy high and sell low. And no, I don't have a reason to be taking losses. Yeah. Absolutely. You're welcome. No problem. Anybody else need another second? Okay. Liquidating dividends. Or dividends paid that are not supported or greater than retained earnings. Some states do not allow this. Just a note, but there are states and cases where that happens.
This would be considered
Generally, liquidating dividends are considered a return of capital for what you paid into it. Okay, so what would you do? You would debit retained earnings. You would debit additional paid in capital. Paid in capital. Common stock. And then you would credit dividends payable. And so you would use total retained earnings balance. This would be a plug, the difference between dividends payable and retained earnings. This would be the full dividend. It just so happens we have an example. Yay! You guys are like, is this class over yet? So we leave the entry up there. And it says a corporation declared a dividend, a portion of which was liquidating. How would this distribution affect each of the following? So paid in capital. We assume that it's more than retained earnings. We know a debit to paid in capital reduces paid in capital. So this would decrease. And then it would also decrease retained earnings. So that would be letter B.
So with that portion wouldn't be taxable.
In general, if you are a taxpayer that has invested, then yes, it would not be. It would not be taxable to you. But you would lose basis in whatever your shares were, and then if they weren't completely zero when you sold them, you basically have no basis in your shares. Any questions today? So we're going to stop here and we're going to start on stock dividends. Okay. So I will tell you what I told my other class. I put this in, and initially it shows now 82 Tuesday at 2 o'clock. I will bump this to Thursday at 2 o'clock. This is the project. Make sure you look it over before Tuesday's class, because we'll definitely at least, I'll answer some questions about it if you guys have any questions. We'll see depending on the time they are available, whether or not we do class or we could be. But this is my first time through this lab, so my speed is gonna be variable, and I will not hold you accountable to something that I haven't gone through a chart.
So let's see, whether, so if there's an issue and an issue, if something just, everybody have a great weekend. Thank you. And I will see you on Tuesday.